Hello, everyone. Welcome to another Webinar Wednesday by Smartkarma. I'm Michael Tegos. Today, I'm delighted to welcome Insight provider Scott Foster, who will present his handpicked ideas in Japan's semiconductor industry. Scott is a securities analyst who has been covering electronics, precision equipment, and robotics, engineering, construction, transport, and other sectors for more than 25 years in Japan. Before we start, just some standard reminders. You can always send in your questions for Scott using the Q&A button on your Zoom app. Please do not reshare the contents of this webinar without express permission. A recording, as always, will be available on the page that you use to register. Scott, thank you very much for being with us. Welcome to the webinar. Whenever you're ready, the floor is yours.
Okay, thank you very much. Today, I'd like to talk about the Japanese semiconductor industry and related stocks. It is quite a large industry, different than the semiconductor industries in Taiwan and Korea, in that most of the companies are equipment companies and materials companies. As an overview, we can say that now major semiconductor producers and producing countries have announced massive investment plans stretching out to 2030. The semiconductor shortage is, of course, well known, and it has resulted in accelerated investments and government subsidies, and it will end when the economy gets back into balance. This is all widely known and should be in prices already. There has also been a significant but unquantifiable amount of double ordering, which we can see in some of the charts that I'll show you. Semiconductor production equipment orders appear to have peaked earlier this year, and shipments look like they're peaking now. Semiconductor production should continue to grow as these investments turn into manufacturing capacity and shipments, but not further and further above historical trend lines. Here are some of the industry data. This is from the Semiconductor Equipment and Materials International Industry Association. Through September, you can see that there was a peak in July. And here's the data from the Japan version, the Semiconductor Equipment Industry of Japan, Association of Japan. Again, through September, peaked earlier this year, not collapsing, more or less plateauing, going sideways. And SEAJ adds its data to the semi data and comes up with a worldwide equipment billings figure. Here, Q2 here is Q2 of calendar 2021, so through June. So this chart doesn't go as far as the previous charts, but I'll call your attention to the orange next to the top. That's China. And you look how demand from China has just exploded. That is probably not sustainable. Here are some charts from two charts from Jim Handy, the Smartkarma semiconductor industry expert. Here through August, semiconductor revenues break records once again, and China is the main driver. And here is the long-term growth track, the trend line, and you can see that we're well above trend, and that is unlikely to continue. So now let's turn to the equipment stocks. Japan offers a wide range of investments in semiconductor production and test equipment, the most in the world, in fact. We're going to focus on 5 of them today: Tokyo Electron, Screen Holdings, Disco, Lasertech, and Advantest. But there are many more, as you can see from this partial list. And here is the SPE demand and growth forecast. This is from Semi. They're perennially optimistic. They're forecasting single-digit growth, low single-digit growth next year to a nice round $100 billion. That means they think things will be better, but they actually have no idea how much better or whether the numbers will actually go up or not. The point here is that momentum has already peaked. Tokyo Electron is an industry proxy. It's Japan's largest SPE maker and rival to Applied Materials, and also important competitor to Lam Research, and those are the two largest American makers of semiconductor production equipment. TEL dominates photoresist coater developers. It's a leading producer of etch, deposition, and other equipment. TEL sales and profits hit record highs in 3 months to June, but those numbers were inflated by a change in the timing of revenue recognition. And that plus industry trends point to peak momentum and likely peak earnings this fiscal year, which ends next March. The shares have greatly outperformed, and we recommend selling into the current strength. Here is the operating profit on a quarterly basis, looking quite unsustainable. And here's the share price. Now, this chart is from Japan Analytics. If you remember our partner Campbell Gunn, these are his charts. We'll have more of them further on in the presentation. The black line is the share price, the gray line, the black line is the relative price, and the gray line is the actual share price. So you see we're far, far above the levels reached in the internet bubble 20 years ago. Screen Holdings, formerly Dynapoon Screen, is the world's leading producer of semiconductor wafer cleaning equipment and the second source for photoresist coater developers. It is now working on 2-nanometer process technology with Japanese industrial science agencies, government agencies, with Tokyo Electron, Canon, and also TSMC. TSMC has become more and more involved in Japan recently, as you're probably aware, most recently agreeing to a joint venture with Sony to build a factory in Japan. Screen's first half results were announced today. They were above guidance. Guidance for the full year was raised. New orders for semiconductor equipment were up sequentially in the second quarter, but China orders were down. It's a lagging alternative to TEL. It's much cheaper than TEL, usually is, but in terms of relative performance, you can look at this as the other side of a pair trade. Here's the orders trend through September. That's the blue line. It should support the higher guidance through next March and probably into next year. And here's the price chart. Disco is the dominant producer of silicon wafer dicing and grinding equipment. Disco had record sales and profits in the 3 months to September, but new orders peaked 6 months ago. Management is guiding for lower sales, profits, and profit margins. They're probably lowballing, but still the trend is sideways to down. The shares are still close to overbought, and the operating profit to sales gearing is nearly 50%. There's quite a lot of downside risk if sales don't come through, so we recommend selling into the rebound. There's the operating profit trend. And here's quarterly orders and sales. Sales forecast to be down this quarter. Orders peaking in the March quarter and then gradually declining through September. The company doesn't have an orders forecast, but its shipment forecast, which is separate from the sales forecast, is down around 62 billion. So down a step from the orders and the sales trend. And here's Disco share price chart, already starting to retreat. Lasertech is a company that used to be not so well known. It became the dominant producer of EUV wafer inspection systems, stealing a march on KLA-Tencor, the American leader in the IC inspection market. Its sales have tripled over the past 3 years and should double over the next 3, by which time orders should level off. The order to installation lead time at Lasertech is now about 2.5 years, and it's getting longer. Shares are selling at more than 110 times EPS guidance for the year to next June, and nearly 60 times our estimate for the year to June 2024. We think it's overbought, and we recommend taking profits. Here's the orders, sales and backlog trend. They have quite a backlog, so that's why we're forecasting growth for the next 3 years. The orders will probably go a bit higher and then start to level off. And here's the chart. It's a total re-rating. This is not to say that is grossly overbought. It's just that when the business tripled in size, everything adjusted. So it looks like it's far ahead of where it was in the past, but it's a different company now. And here's the price earnings ratio. On our forecast, we come down to 60 times in June 24. Advantest. Advantest is one of two top makers of IC test equipment. The other is the American company Teradyne. They had huge SoC, that's logic chip test equipment orders and sales in the June quarter. That will probably not be repeated. But on the other hand, 5G, high performance computing, automotive and industrial demand should continue to support sales and profit growth as the new IC capacity comes online. And if you follow this industry, or if you haven't, Advantest and Teradyne went through a difficult period when the IC test moved from the back end or after IC assembly to the inline test systems that KLA-Tencor sells and Lasertech. And now it's coming back, and it's coming back because the chips today are much more complicated, and the demand for test to keep the yields up, it has recovered, and that's why Advantest orders and sales have recovered. The share price, unlike TEL, remains far below the internet bubble peak. We regard it as a long-term buy. Here's the quarterly orders and sales. Orders through the roof, not sustainable. That's probably 5G related, and driven by TSMC, but actually the sales are to the back-end test houses in Taiwan, Malaysia, and elsewhere in Asia. And here are their orders and sales for memory and SoC. SoC is the logic in red. Memory test is just behaving normally, but SoC has really showed a change in the driver of the business. And here's the quarterly operating income, and here's the chart. Now we'll turn to materials. Semiconductor materials demand, consumables should continue to rise with semiconductor output. We're focusing on Sumco, maker of silicon wafers, and a JSR, maker of photoresists. Japanese companies have more than 50% of the wafer market and almost 90% of the market for photoresists. These are only two of several Japanese semiconductor materials companies. Others include Tokyo Oka, which is JSR's main competitor, Shinetsu Chemical, which is Sumco's major competitor, and the others that you see here. Sumco is the third-ranked supplier of silicon wafers. It has about 24% of the market. Unlike its major Japanese rival, Shinetsu, it's a pure play. They recently announced a new share issue with potential dilution of 21%. That should be more than covered by growth of the business over the next few years. Capacity expansion is likely to be implemented in stages to match demand growth, which is expected to be about 5% per annum through 2025. We recommend buying into the current weakness. Here's the Sumco growth outlook on our estimates. And here's the chart. JSR is the top maker of photoresists with about 35% of the market. They recently acquired a company called Impria in the United States, which has a unique metal oxide photoresist developed specifically for EUV lithography that lays out a 10-year roadmap for sales and profit growth. Please see our recent insight for the details. This new photoresist has demonstrated the highest resolution at the leading edge 3 nanometer design rule currently being introduced by TSMC. It should do the same at 2 nanometer and potentially to 1 nanometer and beyond. The photoresist market is likely to double in size through the next several years, with demand for EUV photoresist rising at about 40% per annum through 2026. We regard JSR as a long-term buy. And here's the photoresist market projection as seen by JSR. They're a little more conservative than Sumco. They're looking at wafer input of 3 to 4% growth per year, and photoresist market growth doubling that. Here's the JSR chart. Stock price has gone way up. That is driven by expectations regarding the new resist. Now we'll turn to devices, the semiconductor products themselves. Japan is a niche player in semiconductors. It has none of the industry's giants, and it's only a minor presence in fabless design and foundry. Renesas and Rome are leading producers of automotive ICs. Toshiba affiliate Kioxia ranks with Samsung in NAND flash memory, but it's not listed. And Japan's large DRAM factory is owned by Micron. Sony leads the world in image sensors, but of course it's a much more complicated investment and not really a semiconductor stock per se. Hamamatsu Photonics is a leading producer of opto semiconductors. Rome. So Rome is the leading producer of silicon carbide wafers and power devices used in electric vehicles. Automotive accounts for 35% of the company's sales, and that percentage is rising and should keep right on rising as the electric vehicle market grows. 20 years of investment in silicon carbide is starting to pay off. And of course, automotive applications are what? Environmentally difficult applications. In other words, a lot of heat and a lot of vibration and a requirement of near perfect performance. And silicon carbide does that better than silicon wafers. Guidance for the year to next March looks conservative, but their second quarter results may show the impact of the COVID surge in Malaysia and other Southeast Asian countries where COVID has been a problem. We'll find out tomorrow when they announce. We recommend buying Rome for the shift to EVs and for long-term growth in semiconductor demand in general. Here's their sales by application. You can see from the bottom, blue and red is automotive and other industrial, over 40% of the total. And here's the share price chart. Now, this too we have to take with a bit of a grain of salt, because 20 years ago, it was a huge supplier to Japan's consumer electronics industry. And that business went away and it's been replaced by automotive and industrial. So the shares look like they've got a long way to go back to the internet bubble, and they do, but the company's business mix is totally different now. So that's not necessarily going to happen anytime soon. Hamamatsu Photonics, leading producer of optical semiconductors, photodiodes, etc., and the dominant producer of photon multiplier image sensors. These are not semiconductor products, but they are highly sensitive image sensors, and Hamamatsu makes about 90% of them. They supply the medical, industrial, scientific, and other markets with imaging devices and equipment. It's not seriously overvalued, but not cheap. That is a general characteristic of this stock. Sometimes you have a chance to buy it on weakness. The share price has failed to regain its February high, despite another upward revision last month. On the other hand, capacity expansion and market trends point to long-term growth. This one is suitable for pension funds and other patient long-term investors. Here's a chart. Renesas is Japan's top supplier of automotive ICs, an extremely important company for Japanese automakers such as Toyota and Honda. Mio Kato at Lightstream covers this stock. He regards it as fundamentally sound, but at risk of a correction. Auto industry demand is likely to remain firm. Factory automation related demand, on the other hand, is at risk if China corrects as Mio expects. Buy this one on weakness. Here's the chart. This one has had, Renesas has had major restructuring issues over the years, and that accounts for this performance. Kioxia, the affiliate of Toshiba, unlisted, major producer of NAND flash memory. Mio covers this one too. He sees upside potential for Toshiba, but primarily as an exit opportunity. As we wrote recently, nano imprint lithography could give Kioxia a cost advantage, but not for at least 5 years. And in the meantime, it's likely to remain a high cost producer, adding to NAND supply with below average margins. Look instead at Samsung, SK Hynix, and Western Digital, and keep in mind this additional supply that's likely to come on despite the lower margins. The IPO would be interesting if it goes public. In conclusion, we're now in the middle of Japan's financial reporting season. Disco and Screen have already announced. The others are scheduled to announce in the next 2 weeks, starting with Rome tomorrow. See our Lightstream Research Insights for details. In addition to Mio and myself, Japanese tech stocks are covered by Shifara Samsuddin in Sri Lanka. And thank you for your attention.
Thank you very much for that, Scott. Quite a few bits of information there to chew on. If you have any questions for Scott, please feel free to send them in through the Q&A button on your Zoom app. Scott, you mentioned before that there's especially increased demand from China. Is that demand covered mostly domestically, like from Chinese companies? And if so, does that present a challenge to the picks that you outlined today?
Well, first of all, China is in the middle of a semiconductor import substitution campaign. They're heavily dependent on imported semiconductors. And the Americans have put the fear of God in them by threatening to cut them off. And on top of that, demand is very strong because the Chinese economy is growing and it's also upgrading. So demand for semiconductors is very strong. So generally speaking, demand for semiconductor manufacturing capacity in China is growing quite rapidly. And the government has every incentive to help it grow. Looking at the customers for the equipment and materials companies, we see that TSMC has major facilities in Nanjing, and Samsung Electronics is a very large producer of NAND flash memory in China. SK Hynix will be too. It's buying the NAND business from Intel, and it will manufacture in China. So there are non-Chinese customers in China, and they're very large. But the demand is in China, primarily for sale in China. You probably read a lot in the press, particularly the American press, that we can't be dependent on Chinese exports of semiconductors, but they don't export semiconductors; they import semiconductors.
Thank you very much for that. That definitely clears things up a little bit there. In most of the picks that you've outlined today, we see that there's, especially in their orders data, there seems to be that running theme of increased demand. Can these companies meet that demand, do you think?
You know, the management of these companies always mention the fact that the semiconductor shortage also affects the semiconductor industry. And they've been doing their best to keep that problem under control. It seems like they have. The orders numbers and the shipment numbers are very good. So I don't think they've had a severe problem, but there's probably some impact there. So that's right. So far, I haven't seen any data or any other reason that would give me cause to write an insight about how semiconductor shortage is cutting off Japanese equipment makers at the knees. That's not happening.
That's good to know. Since you, as you also mentioned, some of those companies' projections for the coming year tend to be maybe pretty conservative. How optimistic are you for the semiconductor industry in the next few years, given the current challenges?
Okay, first of all, I think these companies are deliberately lowballing their guidance because they want to avoid downward revisions. So this is not an unusual thing. This is a typical behavior that has been, if anything, aggravated by COVID and the general uncertainty related to the pandemic and to the American sanctions and economic uncertainty. I think that we've had most of the surge in demand for new semiconductor investment. That means equipment sales. Now it will take 2 or 3 years for these equipment sales to feed through into manufacturing capacity. So I think the output of semiconductors and therefore the demand for consumables used in that production and for testing equipment for the results of that production will continue to grow. But as we saw from Jim Handy's chart, we're already well above trend line and probably will come back down to trend line. Now, usually looked at long term and eliminating factors such as the Lehman crisis, the semiconductor industry grows at about twice the rate of the overall economy. So your risk here is an economic risk. If there is another economic crisis, all these companies will just get slammed. But if there isn't, if we muddle through and growth rates are low single digit like they tend to be, then the trend line for the semiconductor industry will probably continue where it is.
Understood. Thank you very much for that. In terms of the industries that will most likely drive most of the growth, do you see a particular one that could be a key driver, such as, for example, automotive, which seems to have a lot more increased demand, or perhaps 5G technology, or is it kind of like demand across the board?
5G has been a very big story, but it's well along. 5G rollout is well along, particularly in China. Maybe we're halfway through the rollout. Automotive is good, but mainly for electric vehicles. I think the long-term growth driver that's most secure is high-performance computing. And then there are any other number of growth drivers. We're using one right now, advanced consumer and business related demand. The overall use of semiconductors has expanded quite radically and has diversified. So of course, in the past, the PC market and then the cell phone market were the main drivers of semiconductor demand, and they also cause high cyclicality. Well, the amplitude of the cycles has come down as the number of growth drivers has expanded, and the overall demand has risen for the same reason. And I think that's likely to continue for the foreseeable future, again, barring a severe economic downturn.
Thank you very much for that, Scott. And there you have it. Thank you for this very comprehensive presentation. And thank you all for attending. If you have any more questions for Scott, you can email us at research@smartkarma.com and we will make sure to pass them along. Of course, you can find more of Scott's research as well as his colleagues from Lightstream Research work on Smartkarma. So I encourage you to look up those insights. And if you wish to engage Scott for bespoke research services, please contact your Smartkarma account manager and they will help you out in this regard. Scott, thank you very much once again for your time today.
Thank you.
Goodbye.